You may have noticed something lately that feels small at first, but keeps showing up again and again. Your credit card bill looks higher than it used to. A car payment feels out of reach. Even thinking about buying a home feels unrealistic now. It can feel confusing, especially when nobody explains why this is happening, and that's what we're going to slowly unpack today. Before we go any further, I want to say one simple thing. What I'm sharing here is based on public information and official statements, but everyone's situation is different. Nothing here is personal financial advice. It's just meant to help you understand what may be happening around you and why it feels so heavy right now. A lot of people think these higher payments came out of nowhere, like prices just decided to jump all at once. But there's actually a connection behind the scenes that most people never hear explained in plain language. And once you see it, many of these struggles start to make more sense. At the center of this is something called the Federal Reserve. Most people just call it the Fed. It's not a regular bank you can walk into. It's more like the system that guides all the other banks. And one of its biggest tools is interest rates, which quietly touch almost every part of your life. When the Fed raises interest rates, borrowing money becomes more expensive. That doesn't just affect big banks or investors. It slowly works its way down to everyday things. Credit cards, car loans, mortgages, even rent can feel the pressure over time. And that's where many people are getting squeezed without realizing why. A few years ago, interest rates were very low. During the pandemic, borrowing money was cheap. Some people got used to that. Others were just trying to survive. Back then, many believed that once things reopened, life would slowly get easier again. That belief hasn't really matched reality, and that disconnect is important to understand. The Fed started raising rates in 2022 because inflation was rising fast. Groceries cost more, gas cost more, rent climbed. The goal was to slow things down so prices wouldn't keep running away. Raising rates was their main tool, even though it made life harder for many people. Now, here's the part that matters most today. We're in 2026, and those higher rates are still here. They haven't fallen the way many people expected. And recently, the Fed made it clear that they are not in a hurry to bring them down. That message didn't come from rumors. It came from their own words. At their latest meeting, the Fed chose not to cut rates again. That decision itself wasn't shocking. What mattered more was what the Fed chair said afterward, because his words help explain how long this situation might last and why patience is being asked for. He talked about the economy being stable, jobs still existing, inflation still being higher than they want. In simple terms, the Fed believes rates are already where they should be right now, and that belief affects how long this pressure may stay on households like yours. This is where things start to feel personal, because every month rates stay high, getting ahead feels harder, debt grows faster, options shrink, and for many people it feels like they're doing everything right and still falling behind, and that feeling didn't happen by accident. In the next part, I'll break down who is being hit the hardest by these rates and why some people seem unaffected at all. That contrast explains a lot about the economy we're living in right now. When people talk about high interest rates, it can sound abstract, like it's just numbers on a screen. But the impact is very real, and it doesn't land the same way for everyone. Some people barely notice it. Others feel it every single month. And that difference matters. If you have savings, high interest rates can actually help you. Savings accounts pay more. Some investments earn more interest. So for people with money already set aside, this period may feel manageable. But that's not how most people live, and that's where the gap starts to show. If you rely on credit to get by, higher rates can quietly trap you. Credit cards are the clearest example. Many cards now charge very high interest, sometimes over 20%. That means even small balances can grow faster than expected. It can feel like you're paying and paying, but not moving forward. Car loans tell a similar story. A used car that once felt affordable may now come with a payment that doesn't fit your budget anymore. The price of the car didn't change much, the interest did. And that single change can turn a reasonable purchase into something you have to walk away from. Housing is where this really hits hard. Mortgage rates staying high means monthly payments stay high too. For people trying to buy their first home, the math often just doesn't work. Even with steady income, the numbers don't line up the way they used to. And that pushes many people back into renting, whether they want to or not. Renters feel this pressure as well, just in a different way. When landlords face higher borrowing costs, those costs can pass through over time, not always right away, but slowly. That's why rent can keep climbing even when nothing about your apartment changed. It's part of the same system. What makes this harder is that jobs haven't disappeared. The economy looks stable on paper. So from the Fed's point of view, there isn't an emergency pushing them to act fast. Employment is holding. Growth is steady. Inflation is easing, but not enough. That balance is why they feel comfortable waiting. This is where many people feel stuck. If jobs were falling fast, rates might come down to help. If inflation dropped quickly, rates might ease as well. But when neither thing is breaking sharply, the Fed stays patient, and that patience has a cost for households. During the recent press conference, the Fed chair acknowledged something important. Lower-income families are changing how they shop. They are buying cheaper brands. They are buying less, not because they want to, but because they have to. That tells you how tight things feel on the ground. At the same time, people with assets like stocks and property are doing fine. Those values have risen. Spending continues, so the economy moves forward, even while many families feel left behind. That split explains why official reports can sound positive, while personal finances feel strained. None of this means relief won't come eventually. Interest rates move in cycles. They rise, they fall. They always have. This period feels heavy because it follows years of very low rates. That contrast makes the change sharper, but it doesn't mean this is permanent. The Fed's goal isn't to punish households, it's to prevent inflation from getting out of control again. That trade-off is uncomfortable, especially for families already stretched thin, but understanding the goal helps explain the choices being made. Here's the calm reminder I want to leave you with. You're not failing because things feel harder. The system is tight right now. Many people are adjusting at the same time. Getting through this period is about patience, information, and small, steady decisions, not perfection. Knowing what's happening gives you control, not over interest rates, but how you respond to them, and that awareness can make this stretch a little more manageable.
One thing I don't want you to take away from this is fear. Yes, interest rates are high. Yes, life feels tighter. But understanding the moment we're in matters more than reacting to it. When you know what's shaping the economy, it stops feeling random. A lot of frustration comes from not knowing why things changed. It can feel personal, like you did something wrong. But this isn't about bad choices or effort. It's about a system adjusting after a very unusual period. Low rates didn't last forever, and now we're in the correction phase. That doesn't mean you should stop planning for the future. It just means the timeline may look different. Some goals get delayed. Some paths change. That's not failure. That's adapting to conditions you didn't create. If you're carrying debt, the focus right now is survival, not perfection. Reducing interest exposure where possible, avoiding new balances when you can, paying what's manageable, not what looks good on paper. Those choices add up quietly over time. If you're saving, even in small amounts, that still counts. $50, $20, whatever fits. That cushion can prevent stress later, even if it feels modest now. Progress doesn't have to be dramatic to be real. It's also okay to pause big decisions, buying a home, taking on a new loan, making a major financial leap. Waiting is a decision too, and sometimes it's the smartest one available. There's no prize for rushing during a tough cycle. What matters most is staying informed without getting overwhelmed.
Headlines can be loud, predictions change, but the core signals move slowly. Watching those signals helps you make calmer choices. Here's the trust reminder I want to share before we wrap up. Nobody has a perfect roadmap right now. Not policymakers, not economists, not families. We're all responding to the same conditions, one step at a time. Being careful, curious, and steady matters more than being fast. This channel exists to help you understand what's happening, not to scare you or sell you hope. No promises, no pressure, just clarity, context, and tools to think things through. That's it. If this explanation helped you see the bigger picture, take that with you. Use it to make choices that fit your life, not someone else's timeline. And remember, hard periods don't last forever, even when they feel long. Thanks for spending this time with me. I'll be here breaking things down calmly as things continue to change.